Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with James Davolos. How you doing today, James?
Doing great. Thanks for having me.
Good, good. Well, really excited to have James come on the show this week. Been trying to get him on the show for a while. But James, maybe you could tell us a little bit about your background so listeners get to know you a little better.
Sure. I think I'm pretty unique in the sense that I joined the current firm I'm at, Horizon Kinetics, in December of 2005. So 18 years all at the same firm directly out of undergraduate. I know the firm has really allowed me to start in a pretty junior role, transition into research, ultimately sponsored me for my MBA locally in New York, and then have finally taken on some sole portfolio management responsibility. But Horizon's been around since 1994. I'd say we're eclectic value, so we're doing things within the value universe, mostly equities that you're not going to see in benchmarks and indices. And that results in having very different portfolios compared to the broader market. And so I would now, more as a function of opportunity set than any type of formulaic process, I'd consider myself some of a pseudo specialist in what I call real asset markets. So um, broadly, resources, infrastructure, energy, financials, kind of anything that kind of meets that criteria. And we think we have some really unique ways to play that. But obviously, a lot of interesting things going on in the world today as it pertains to these and other assets.
Cool. Well, let's dive into those areas because I think there's certainly a lot to talk about. I know you guys are a good value shop, and there's it's funny. I mean, we've had I don't know what the last 15 to was it 20 years now. It's been a long time since value's really been in favor. Um, and maybe you can talk a little bit about that trend and like what's been going on for the last 20, 25 years and like how that's kind of impact and like what's impacting the market in a way where it's really so one-sided.
Yeah, that's a great question. And I think people kind of look at it through the wrong lens, where it's growth or value. I think that increasingly people are understanding that there's companies that have strong operating metrics and are growing but are priced at a value. But more broadly, I think that the bifurcation of the market in how indices define value versus growth has created a lot of this discrepancy. So on the value side, the indices simply look at things such as price to book, meaning a lower price to book, also low price to earnings. But unpack that, what does that mean? A low price to book probably means you have a low return on assets. Maybe you lever that up and have a reasonable return on equity, but value indices are going to be full of things like financials, certainly balance sheet intensive financials like banks, insurance, materials, energy, industrials. So kind of the old economy. And the last time that these companies were in favor, where they were outperforming the market or growth, was really that cycle following the tech bubble bursting in 2000. So from 2000 through 2007, even into early '08, value was trouncing both the broader market and growth. And basically, ever since, it has been just maybe some small fits and starts. We thought we had a little bit of green shoots in terms of value starting in 22, but then 23 just snapped right back without any rhyme or reason. But why, maybe we could unpack why has growth outperformed. So obviously these are the higher growing, more richly valued companies, and all else equal, if you take interest rates to extremely low levels and pump money into the system, they are going to grow revenue. And by definition, they have a longer duration, meaning their cash flows are much further out. So this is almost the perfect environment. And this has been going on for decades. So lower rates, higher profit margins, stimulative spending by government promotes revenue growth. And generally, investors don't really care about revenue converting into earnings for some of these tech companies. So that's really the top down as to why the higher growth companies. Now, obviously, there have been some idiosyncratic things such as AI and software adoption, but writ large, I think it can really be explained as a very beneficial macro environment for the underlying drivers of growth relative to the underlying drivers of value. That's not the whole story, but I think that that really explains a lot of the plight of the modern value investor.
So what's going to change? I mean, I think it, I know we're going to get into this later in the interview, but, what do you think is going to change that dynamic? Because every year I hear people saying, well, this is going to be the year, this year value is going to take off. And as you said, in 22, it actually did outperform, although negatively, everything was negative, but it did outperform. But, um, I guess at some point, the buck's got to stop somewhere. So like, where do you see a potential transition point, or what would have to happen for that to, or what has to change in the markets to actually have that kind of change theme?
I think we really need to approach that question from two lenses. One is the fundamental side, and then the other is the market structure side. Caveat emptor, I don't know, but I'll give you some theories that hopefully can help you make an informed decision that may or may not align with mine. But let's start with market structure. Though, in addition to the last 30 years being highly accommodative of the growth factors, we have also seen a even more extreme cycle of passive investing. And passive investing is by definition price agnostic, as most of it is market cap weighted. So if you are investing in an index, if a tech company is trading at 100 times revenue, you don't care. You simply just buy it. So when these companies run to extreme levels and they come higher and higher in indexation, you're just getting dollars going into that company. And the passive flows, whether it's from migration from active to passive, but also all of these formulaic, whether it's employer 401ks that are going into indices, if it's 529s for college employment, if it's retirees. So that constant bid, which is being hyper focused into the largest companies in the world, no surprise that the Mag 7 are the leaders when you think about that dynamic. So from a market structure standpoint, what changes that? I think you need to see some sort of a recognition by the market that this is unsustainable, or some sort of inflection point where the fund flows abate. And perhaps there's something going on with target date funds where the concentration of wealth in the country is with baby boomers. As they need to start ratcheting down risk and going into tiered debt, does that stop this constant bid? Does outperformance in other countries, maybe a weakening of the dollar, does that prompt people to seek diversification internationally? But I can't stress how important this constant bid going into the largest constituents, which are by and large growth, that's just such a pervasive trend that needs to end. Now, we thought we were seeing some green shoots of that with the declines in 22, but then liquidity just came back into the system in 23, and you saw all of these companies just go flying again. And so to the extent there's a sentiment or animal spirits component, obviously we might have been at an inflection point at the end of 22, and then it really just broke down altogether. In terms of fundamentals, I mean, ultimately as a active value investor, we have to hope, think, assume that fundamentals matter. To quote Warren Buffett, they don't until they do, and when they do, you're glad you care about them. But I do think that the macro and some of the micro is realigning. So when you look at some of the components of the value indices or the value factor, there's a lot of energy, industrials, materials, things that have been structurally underinvested in my opinion, for the better part of 20 years, or certainly going back to the global financial crisis. We oversupplied the world with almost every raw material, leading into kind of the BRICS miracle. If you recall, Brazil, Russia, India, China were stimulating theoretical growth forever. Well, that came crushing down in 2008 and 2009. That that malinvestment is catching up to us, and it's catching up quick. we've definitely remedied some of these prices with short-term factors that I think are going to start burning off this year. I also think that in a market where you have a real positive interest rate, so that means an interest rate in excess of inflation, that's a stock picker's market and things don't go straight up forever. So even looking this year, look at the bifurcation in tech where non-profitable tech is down 10 or 11% year to date, even though big quote quality tech is up. So I think you're starting to see that because now that there's a real cost of capital, now that there's actual pressures on profits, and now that you can't just issue stock and grow revenue without thinking about margins forever, I think that there is a fundamental shift as well. So it does seem as though the stars are aligning for this shift, but when you talk to the average observer, all they care about is the latest AI company without any thought whatsoever as to the valuation, addressable market, unit economics. It's just AI, buy it, it's going up. Amen.
Yeah, it's a great point. I mean, technology certainly has driven a lot of this, as well as the dynamics you mentioned. I think what's fascinating to me is for the last 10 plus years, I've been hearing, hey, Europe's cheap again. Let's buy Europe. And no one's buying Europe. It's like I heard that right before Ukraine erupted. It was like, hey, Europe's cheap. You should get, and there was always this like beating the drums. And then the Ukraine war started. I'm like, well, it's not really cheap anymore. Like, could be really expensive. We'll see. But it just kind of brings up the fact that, I mean, for, I don't know, 10 plus years, the US has been an oasis in the world of the place to put money. Big tech in the US, even when other countries are not doing so hot, we always are, and money's just flowing in. So it brings me my question of like, what is going to cause that to shift? Because I thought that with rising interest rates, that would put, a foot on the brake of the economy. And yet, in some places it has, but in large part it appears to still be chugging along, and the stock market doesn't seem to care. There was a time where
Yep.
people would look at that and say, "Hey, let's start selling everything that's not nailed down because it's going to get ugly." And now it's like, the fundamentals don't matter anymore. So, what do you think? How long do you think it's going to take for higher interest rates to actually impact the economy and the markets?
It really depends. And the big variable today is the fiscal spending. So the mo- interest rates are only effective in so much as they are aligned with, or at least not fighting with fiscal policy. Fiscal policy meaning government spending. And we definitely changed the world, I think, forever in 2009 when we, as the United States, but collectively the developed world, decided we needed to engage in enormous fiscal spending to solidify the financial system. And I can't disagree with that. Obviously, it was very difficult times and we needed to inject that liquidity. Warren Buffett wrote an incredible op-ed in the New York Times during this period saying, look, this was necessary. But if you look at the current fiscal deficit and if you look at the debt to GDP, we are on very thin ice. And he likened it to, it was called the greenback effect, playing off of butterfly effect. Basically, if you go back into time and change things, they can then create a ripple effect. And he was very concerned in 2009. So if you go back to 09, we spent for 3 years basically between 1.3 and 1.4 trillion dollar deficits, which were between 8 and 10% of GDP. Enormous, but necessary. The interesting thing, though, is for the next 7 years until we got to the pandemic, we were still running between 3 and 4% deficits. So these are $500 million to $1 billion deficits. So still very substantial and still very elevated compared to pre-2008 non-war spending periods. Now, when things really went haywire is 2020. And again, I'm not contesting the appropriateness of this, but it's when does it normalize? So in 2020, we spent 3 trillion, just under 3 trillion in 21, $1.5 trillion in 22, and this year we did $1.7 trillion. So that's a 14%, an 11%, a 5%, and a 6% respective deficit. Now, here's the kicker. The Congressional Budget Office publishes 10-year budget forecasts, I believe, semi-annually. It's a nonpartisan agency that is objective, at least, perhaps a bit optimistic. They project a 6% deficit for each of the next 10 years. So that's $2 trillion this year, rising to $3 trillion by 2033. So how effective is monetary policy and rising interest rates within the context of 6% or $2 to $3 trillion being injected into the economy each and every year? I think another interesting lesson from history, though, so again, I'm going to punt that. I don't know when interest rates are going to matter. I think they're certainly going to matter with very rate sensitive, spread-based financing investments. So real estate that, guess what? They cut 100 bips, but the yield curve goes from inverted to positive sloping, and you're benchmarking off a 10-year. There's still a lot of properties out there that have negative funding relative to their borrowing costs. Cutting rates and leaving rates as high, I mean, neither is going to really help. So there are some problems in the pipeline from interest rates, but it doesn't seem to be having a broader effect on the economy because of this fiscal spend. But just going back to the earlier example of like what slows down tech, what slows down the hegemon of the US. And again, I love the quote often associated with Mark Twain that history does not repeat itself, but it often rhymes. If we look back at the Nifty 50 experience of dominant US blue chip stocks in the 1960s into the early 1970s, these are household names today, things like Walmart, Polaroid, Coca-Cola, McDonald's, incredible companies and turned out to be incredibly successful companies. But if you pay too high of a price, you can have a very negative investment experience. What ultimately pricked the bubble of the Nifty 50 was the inflationary episode in the early 1970s, which then ultimately resulted in a shift in monetary policy under a Volcker Fed. So again, it doesn't repeat, but it certainly looks like it's going to rhyme, and I see parallels to the Nifty 50 in the 70s for sure.
Yeah, and before we get into that, I do want to ask, because you mentioned the fiscal spending and is gonna skyrocket. The question I always have is, does it really matter? Like everyone talks about, we got all this debt, got the deficit and all this. Does it really even matter? Like it doesn't appear to matter. I guess maybe there is a point, but I don't think we're near it, or else we'd probably see impacts of that. But like, does it matter? And at what point should we just say, okay, now we have to be careful?
Yeah, I mean, I think it doesn't matter until it does. And who knows where that tipping point is. You have this new school of thought, modern monetary theory, which basically posits because the dollar is the world reserve currency, we can just print as much money as we want and issue as much debt as we want. But that's predicated on the Federal Reserve buying our debt. And if we start doing that, inflation is coming right back and it is soaring. But right now, the Fed is very slowly tapering, meaning selling down some of their maturing or not renewing some of their rolling over debt. But the CBO forecasts assume that the public is going to fund this $2 to $3 trillion a year every year. I think at a certain point, unless we undergo what Russell Napier would call financial repression, so this would be a scenario where we implement rules that force banks, insurance, depository institutions to hold US treasuries. I think it's going to start mattering when we ultimately have to rely on the public and then look at all the foreign counterparties that are pushing back on the dollar about holding our debt. I don't see China buying that much more. I don't see a lot of European and Southeast Asian institutions buying that much more. So the question is, who's going to buy this debt and at what price? Two scenarios. You issue less, which I don't think this government is going to do. Or you, again, I don't like this word, but sterilize it, meaning you have the Federal Reserve buy it, which is quantitative easing, money supply growth. And again, I think that that just gives you this implicit or continued inflationary bid. So there is no easy answer. I think the system needs this type of spending and this type of liquidity. And so the financial stability, which I think is a new mandate of the Fed, requires some degree of this. And I think that that's why the regime has changed. We're not going back to 2% inflation, at least sustainably. We're not going back to this Goldilocks 2% growth. We're not going back to a world of low to no volatility. And this is really the limiting factor that I don't think gets enough attention.
So you mentioned, yeah, you mentioned the old kind of paradigm as we call it here, of the 0% interest rates, 2% inflation. Um, you know, why would we not go back there? I mean, we have interest rates at 5.5%. I'm a little curious if you see them actually going higher from here as well. I know there's a lot of impacts that are not currently baked in. I mean, one of the biggest questions I really have is if I look at the interest rate prediction of where Wall Street thinks rates are going to go and where the Fed is going to go, they've been drastically wrong for the last 2 years. And even now, up until last week, they were very, very wrong. I haven't looked recently if they've caught up to more realistic numbers, but when you have Powell, who's been very crystal clear about his intentions, like you can't misread it, and everyone just doesn't believe him. And so, I guess the question is why? Like, why is Wall Street not pricing in higher rates? Why are they not pricing in rates for higher for longer? Because I would assume that's going to have a big impact on the stock market as well as the economy as a whole.
Absolutely. And I think let's address the first. Why is it extremely unlikely that we're going to go back to that pre 2020 equilibrium of low inflation, low rates, low vol, everything is harmonious? I think when we look back at what allowed this 20-year period of disinflation, there were a lot of one time variables that are ending or reversing. So go back to the late 90s, globalization was a huge tailwind because not only the efficiencies of globalization, but also the mobilization of labor and resources. In the West, we've been importing disinflation by virtue of cheap resources, cheap goods, cheap labor for over 25 years. That also coincided with the internet and obviously all of the efficiencies and productivity gains associated with the internet. So those were two enormous secular trends. And I'm seeing deglobalization, I'm seeing onshoring, I'm seeing friendshoring, I'm seeing rising wages both domestically and in non-OECD countries. We're seeing protectionism around resources. We're seeing lower grades of resources. So all of those variables that really were instrumental in dragging CPI down to that 2% level are almost impossible to repeat today, especially as we're seeing rising GDP per capita and standard of living in the East. And I think a lot of Fed models assume we're going to go back to that disinflationary goods environment. Now, a huge wild card there, which I think is too long, maybe we can talk about it later, is China. But China was also a huge driver of disinflation through cheap goods and manufacturing. And I think a lot of the dynamic of the Chinese economy and interaction in global markets is changing very, very rapidly. But then moving to your question on rates, and it's amazing to me. I agree. People have consistently thought, all right, if we go to 3%, it's going to break something. Or, all right, well, if we go to 4, it's going to break something. And if you look at the Intercontinental Exchange has a really interesting, it's a free Fed tracker tool. The CME has one too on their website. But historically, there's always been this negative sloping curve of rate expectations. Then you look at the dot plot of the Fed, and it's not even remotely close. And so I think there's been this belief or bet that something was going to break because of higher rates, and that really disregarded or didn't properly discount how important all of this fiscal spending was going to be in propping up both asset prices as well as underlying economic activity. So again, I have no idea what the trajectory of rates are going to be, but I'll tell you, I'm extremely confident that when we had, before this latest Fed meeting, when we had 7 priced into futures markets, I was pretty darn certain that what's going to happen, barring a massive exogenous negative shock. I think it's going to be very difficult for them to raise rates because I do think there's vulnerabilities in certain aspects of the financial system, mostly real estate, perhaps some private credit, and not to necessarily cross the Rubicon here into politics, but I think it's going to be really hard for them to do that in an election year as well. So definitely don't think that we're going to be cutting hundreds of basis points the way that some people might think, but I don't think that we're going to be hiking. And I think that this is going to be a really interesting dynamic as the market has to digest this reality as it keeps betting on this return to 2019.
So I'm curious, there's 2 points to this. You'd mentioned real estate. I'm actually very curious. I mean, real estate, we had a equilibrium rate, whatever that was, prior to COVID, and, of rates and price and where things are. And then COVID kind of skewed everything. Um, and then mortgage rates went from, we'll call it 3, in some cases went under 3, went 2.5 in some cases, but call it 3 up to 8. I forget, it was 7.5 now or 8, but like say 8, like you're basically, if I were to buy a house today, it's going to cost me twice as much in payments than it would have cost me 3 years ago. And yet real estate prices are the same, if not gone up. So what is, and I have this debate, I'll just context this a little bit. I have this debate with people where everybody says, well, it's supply and demand, they're not making enough. I'm like, yeah, but you still have to live somewhere. Like I can't afford to buy the same house I could buy before. So it's not that I don't have a house. There's no roaming band of gypsies running around saying, "Oh, I wish we could find a house." Right? There's
Yeah.
housing. It's a question of like, is it supply and demand? Is it rates? Like what's going to break the real estate market? Like it just seems like it just keeps chugging along as if no one cares. And I don't know how people afford it, but what are your thoughts on the real estate market?
So big distinction here between single family residential housing and then real estate as an asset class. What you're talking about is single family homes, and yes, the carrying cost for the mortgage when rates went from, let's call it 3 to 8, has made affordability at a historic low. But because of that, we're not seeing people that would otherwise be selling moves. So let's say, obviously you're much younger than this, but let's say you were in your late 60s, early 70s, and you said, all right, I'm cashing in my chips. I've been in the Northeast and the suburbs. You're probably sitting on, I don't know, depending on when you bought your house, 3, 5x in terms of equity gains net of your debt. And then you say, okay, well, minimum, I want to look at what I can afford by my current payment. Or if you have no debt, then you're looking at what can I afford on my budget, which is presumably retirement savings. And you're saying, well, I can't. If I leave this house, I'm going into something categorically worse, and I'm taking a tax hit if it's over the deduction limit on capital gains. So I think there's a massive stock of housing where people that would otherwise be downsizing or moving or going to Florida, et cetera, are just saying, I don't have the economic ability to do that. And I think that that's more of the supply side dilemma, because we're also not adding new units, but a lot of these markets that we're talking about don't necessarily have a lot of area to add new units. It's more attrition, teardowns, and then rebuilds. But I think that that is a big component of what's propping up the single family housing market, particularly in areas like the Northeast where, and major city centers with good education, good schools, et cetera. I think it's a very different dynamic for investment real estate. So when rates were extremely low, so SOFR, which is the benchmark overnight funding rate for people that use floating rate debt for real estate investments, it wasn't that long ago that that was effectively at zero, 5 basis points. And let's say you were borrowing at 5 basis points plus a 400 basis point spread. That means 4%. So your effective borrowing rate is 4%. People are actually going in and buying properties at 3% yields, but they were assuming that they were going to increase rents and they were going to do all these fancy things and they were going to use different maneuvers to basically create value, create equity with leverage, and then cash out and just dump it onto the next person. There's trillions of dollars of that type of property that got caught holding the bag, where they might have a 4, 5, or a 6% yield on that property, but now their floating debt could be 7, 8, or 9. And there's properties where, yes, the cash flow has increased, but what about properties where you've seen a deterioration, whether it's retail properties, meaning storefronts in cities, or strip malls that haven't been doing as well without good anchors, but also office, where we've seen just a huge shift in the U.S. In terms of work from home and lower office demand. And so when I talk about the rate sensitivity of real estate, what I'm really referring to is the latter category of investment properties that are ultra, it's a funding spread based mechanism. You're buying a cash flowing asset, presumably financing it for less, and that's been flipped upside down. And you can only hold on for so long, generating a negative cash on cash yield, until you can either just stop injecting more capital or something has to give. And I think for certain types of properties, we're seeing Class A landlords giving back keys in office. And now I'm seeing 1 million multifamily units are forecast to be coming online this year for multifamily. So tricky environment for investment in real estate, given those dynamics and rate dynamics. Multifamily is far trickier and a lot more idiosyncratic around that, equivalent move, tax equivalent rent, when you're looking at where these houses are concentrated in that 45, 55, 65-year-old demographic that's stuck.
Yeah, as we kind of look through all these, I was constantly shaking my head because all the things that we think we know to be true about the world, they don't seem to impact things in the way that we expect. Like we were talking about before the show of like the 1970s and how there's a lot of similarities to the 70s, but would not necessarily repeat it. So it kind of makes me wonder because I know you run an ETF that's related to inflation, and it's what's puzzling. Some of the puzzling things to me, like gold, for instance, and silver, historically have been great hedges against inflation. Real estate as well, although real estate's had some skewed numbers in the last uh, whatever it is, 15 years. But if I'm looking at gold and silver, silver's done nothing. And everyone talks about how next year silver's going to take off. It's great. And there's supply and demand and this, that, and the other thing. You always hear the stories, but it never goes anywhere. And then gold has been lackluster considering the inflation we've had in the last few years. So I guess I'm wondering, like, is the market not interested in gold anymore, or are there other dynamics going on that are impacting it? Because to me, it seems like it should be doing better, but it's not. So I don't know. What are your thoughts on gold and how um, the price is kind of catering towards the conditions that we have in the market?
Really good question. And I debate this myself and I discuss it with colleagues all the time. And I think there's a lot of factors, but I think what it really comes down to for gold is gold, especially financialized gold. So futures markets, which really dictate the gold price. It's the tail wagging the dog. It's not the physical market, meaning central banks or big buyers buying bullion. That market is incredibly sensitive to real yields. So the bond yield minus inflation expectations, which has gone radically higher, and the value of the US dollar. So these have both been enormous headwinds. You could say hurricane force winds in the face of gold, but gold is still up here hanging out around all-time highs. And I think that that resilience shows you that there is a pretty strong underlying demand for gold. But you also, I think, have to remember that gold moves for two reasons generally. Um, Inflation or stagflation or debasement of currency, or uncertainty and fear. So recall in '08, gold was one of the only assets that did well because it was the doom trade. So something that will hopefully hold its value. Gold surged during the pandemic where everybody said, give me something physical, even though you're owning it through a stock exchange, in theory, you could shove it under your bed. So it kind of ran in front of fundamentals. The world did not collapse into anarchy, and it bounced around between 2000, 1800. Here we are back today over 2000, despite these enormous headwinds, meaning the dollar and rates. Now, I'm not, I'm with you. I don't necessarily think we're going to be cutting as much as the market expects, but I do think we're going to cut. I do think you might see some pressure on the US dollar. And if the fiscal situation dictates or anything else kind of cracks in the system, I see a lot of asymmetry upside for gold relative to downside, kind of given where the fundamentals lie today. But I think when you look at it within that context, I think the resilience of gold is pretty remarkable.
Yeah, there's certainly a lot of gold bugs out there, and I wouldn't call myself a gold bug, but I do like it. And I also wonder because you have the new gold, what is in air quotes, cryptocurrencies, Bitcoin being the primary one that most people look to. I wonder how much of that how much of that has had an impact on the price of gold, or if that's just speculation. I mean, you're right. Gold has been resilient for sure. It's certainly held up better than silver. But it does kind of lead me to believe, like, if we're in this new paradigm, which clearly are with higher rates, where are the places people should be looking? I know we got about 5 minutes. We got to wrap it up, but like, where should people be looking here for portfolios? Because things are. I mean, the '70s. One of the markers for the '70s was a sense of like mass confusion of not understanding why things are happening the way they are, and why is this happening? It doesn't make any sense. And stagflation wasn't coined until after, and they're like, oh, it was stagflation, but at the time nobody knew what it was. So it kind of leads me to believe, like, how would you recommend people navigate this kind of environment where a lot of things just don't make sense in the logical sense?
Yeah, look, it's not intuitive, but if you look at past cycles in terms of rates, in terms of inflation, and we're working with limited data, but we can look in different countries that have had inflation and rate cycles. But the only real one we've had here is in the '70s, and inflations and big rate cycles before that were just so different. It was a different financial market, so they really aren't comparable. But what works is intuitive. It's hard assets, it's real assets. So it's things that are tangible, they're finite, there's inelastic demand, things like natural resources, theoretically energy, real estate, agriculture, that entire real asset spectrum. But I would caution that it's not as simple as just throwing darts into the real asset universe, because yes, the prices will go up, the cash flows associated with the businesses will go up, but you need to understand what the cost structure looks like and the valuation. So if real estate is still pricing in a reversion to 2019, or infrastructure, sure, you might do okay because their cash flows have a positive gearing to an inflationary world, but you're not going to do as well as you think. Also, in terms of resources, you need a capital light business model that doesn't have the commensurate costs associated with the revenue growth, so that can accrue to shareholders. So I know we're tight on time, but I just want to give a few quick examples about why capital light is so important. And so gold, we mentioned gold, we both like gold, we both see the merits of gold. Let's say in 2006, when the largest gold miners ETF was launched, the first and largest, you decided you wanted to express a view on gold. If you bought that gold miners index in 2006, through today, your total return, including everything, is negative. So you've lost money over 18 years. That is a much more bitter pill to swallow, considering if you bought gold itself, which was 600 an ounce, today slightly over 2,000 an ounce, you've made over 3 times your money. But if you owned a capital light royalty business, you've made anywhere from 5 to 7 times your money. So that shows you capital light, where you have controls over your expenses and allow the business to compound, is so critical. Another quick example in oil and gas. So if you did the same thing when an oil and gas ETF was launched in '06, if you bought oil or the oil and gas ETF, recall in '06, a lot of people thought we were entering peak oil, meaning peak supply. Now people seem to think we're entering peak demand. I think both are going to be proven equally incorrect. But over the next 18 years, you've effectively made zero return in your spot oil trade, and you've made a modest to negative return in the oil producers index. If you bought a royalty, you have made anywhere from 3 to 7 times your money. So this just shows you why capital light business models are so much important. So you could have gotten gold right, oil right, financial services right, real estate right, infrastructure right. But if you don't pay the right price and you don't understand the right business model, it's very ambiguous what your returns are going to be as a shareholder. And so that's why we really call our strategy a capital light real asset strategy that just so happens to be very well aligned with this regime shift that we envision.
Okay, great. Well, James, I really appreciate you coming on the show, sharing your wisdom with us. Where can people find more about you?
Sure. So our website, horizonkinetics.com, we are known for our prodigious research. We show a lot of research. If you look under products, the inflation beneficiaries ETF is this capital light real asset strategy. There's shareholder letters, there's case studies. There's a white paper that focuses on royalty specifically, which I just mentioned. We have a recent webinar and annual letter, which I think delves deeper into some of these topics that we discussed, but great place to start. And we have plenty of information, and always just reach out to us directly as well if you'd like more information.
Awesome. Well, James, once again, thanks for joining us, and we'll probably have you back on in the future because inflation's not going away, in my opinion. So we'll bring you back on to talk about all these things. So thanks again for joining us.
This is great. Thanks so much for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with James. Really appreciate him coming on the show. Now we're into the panel portion of the show. We have our very own Barb Friedberg. Hey, Barb.
Hi, Kirk. Good morning and happy to be here.
Hey, great to have you. And it's just going to be me and Barb today because our panel's a little light. It's spring break week and everyone's off doing fun stuff. So it's just going to be me and you, Barb, today. So this will be fun.
No fun stuff for us other than talking about inflation, value investing, and real estate.
Yeah, absolutely. Well, I think I really enjoyed this interview with James, and he's got an interesting ETF that I've tracked for a while, and I think what's interesting is that if we talk about this in the show, probably not enough, but we definitely talk about it in the show, is this paradigm shift that's going on. And I think I wish I had a better name for it, but the paradigm shift basically is we've had a extended period of time from pretty much 1980 up until 2020, the end of 21, where interest rates went down in yield and they went up in price, and they were considered safe for all these audio viewers. I'm using air quotes. They're safe bonds. Well, they're safe because interest rates were going down for 40 years. However, that's changed, and bonds are no longer safe. In my view, no, the Wall Street could still consider them safe or lower risk. I don't. When 30-year treasuries go down close to 50% in close to in around a year, that's not safe in my book. That's actually highly risky. That's what happened in the global financial crisis when prices went down 50 to 60%, and bonds went down that they were supposedly safe. Well, they weren't safe. So it raises the question of, we're in this new paradigm of higher interest rates or rising interest rates. And higher inflation, that changes the game. And we've all got accustomed to this environment for 40 years. Now we're entering a new paradigm. And the new paradigm changes a lot of the assumptions that you're making. Real estate always goes up, bonds are always safe. All these assumptions that we naturally make are not necessarily the case anymore. And we have to reassess those assumptions. So, Barb, what are your thoughts? I mean, we have obviously the CPI picked up a little bit last week, and the Fed is getting a little squirrely with their comments. They were talking about they're going to lower rates a lot this year, and now they're hedging their bets. So, what do you think's going on? Like, how do you see the world through your lens?
I want to jump on your bonds comment, because there's a difference for bond investors between buying individual bonds and buying bond funds. Because if you buy an individual bond today, paying a 5% coupon, you're going to get that 5% interest every single year. And when the bonds mature, you're going to get your principal value back. So in that sense, you're not going to lose any money, except which you might lose to purchasing power should inflation rise. Bond funds, on the other hand, vary, because you never have that end date where you're going to get your money back. So bond funds go up and down in value, and as do regular bonds. But the difference is you don't have to sell an individual bond until maturity, whereas bond funds are constantly going up and down in value. And frequently that value is based on how interest rates move. Interest rates go up, bond values go down. And that's just the nature of the asset. So I would like to say, no, like you said, Kirk, they're not quote unquote safe, but really, what does safety mean in investing? Because literally there is no safe asset. Even cash, if you invest in cash, like you buy a CD, you get a 5% interest rate. Well, if inflation jumps up to 6%, then you're in essence getting a negative 1% in real terms of value. So I'd say what was the gist of this? So okay, so where are we in terms of investing today? So this is kind of a tricky situation today because we've got interest rates which are historically very reasonable, very average, but they're a lot higher than they've been for the past 15 years. So people got used to that low, 0, 1, and 2% range, and now they're up, 5% or whatever, and that's jarring. We've got the stock market today, which by many, many, many metrics is very richly valued. People typically, when interest rates go up, stocks kind of temper out, or maybe they go down a little. Well, that's not happening. They just keep on going up. And so we've got an unusual situation. I would even say, Kirk, we might be in a little bit of uncharted waters. So the question remains, how do you make sense of all this? And I guess for just the simplest answer is you make sense of it by being in a diversified portfolio, because certain sectors are going to go up, others are going to go down. Different asset classes will go up, others will go down. And when you have a diversified portfolio, you may not get the best return of the best asset class, but neither will you get the worst return of the worst asset class.
Yeah, I think what's interesting is if you look at the 70s, the period of the 70s, which was mired with stagflation and a lot of bad stuff. You had the oil spike, you had a lot of stuff going on back then. And certainly in many levels, if you watch I actually thought, if you've ever seen the movie Miracle, great movie, by the way, and as a hockey player who kind of lived through the era where the Russians were, the best thing since sliced bread, and they were the best, hockey players in the world. I understood the sentiments of that movie, and one of the things was that the I guess the feeling about us being, the shiny country on the hill, being like the best country out there in many ways and being number one, that was largely fading, and for many reasons. And what was fascinating to me is just the overall feeling was just depressed. And then when the hockey team won, it just gave everybody a big shot in the arm. But what I liked about the movie is it really showed all the garbage that was going on. I mean, all the the military conflicts and whatever. It was not a good period, right? And then you talk economically, we went from being overvalued in stock prices to stagnation for over 10 years, close to 15 years, where it's just economic stagnation. And they actually coined the term stagflation because we had high inflation, which normally you'd think, well, high inflation, it means higher productivity. No, we had high inflation and we had low productivity. We had low economic growth. And so if you think about the dynamics, and we actually had a good interview, I interviewed a guy yesterday on this about deflation, which I'm excited to bring out. That'll come out in June. Is the fact that when you have inflation, it relies on growth to continue, because if it doesn't, you have Zimbabwe, right? And you have hyperinflation, because if you keep inflating and the economy is not growing, then you're building up debt that you can't repay. But if the economy grows, it can pay for the debt and you can keep adding debt. So there's this machine. And I'm not saying it's a good thing, right? I don't support it at all, but it's the system we have. So for those of you listeners who are saying, yeah, but that shouldn't be, what should or shouldn't be is irrelevant. The fact is, it is. We live in this world with an inflationary based system. You don't have to like it, but it still exists. So based on the system that exists and reality that we have to live with, because we don't have a deflationary system, which would be interesting, but we don't have that. So if you look at the existing system, we had a high inflation and a low growth environment. That's really bad, right? And it's hard to get out of that. Now, there are some things that does, which is it lowers leverage and lowers the amount of debt, there are defaults, all those things that helps clean up the system, which is what happened in the 70s. Because as soon as the 80s hit, inflation dropped, and all of a sudden we had this massive growth for the next 40 years, which included a lot of debt leverage, I'll mind you, and a lot of debt creation, which was part of it. However, we're at a period in time which, in my opinion, is very similar to the 70s. In the 70s, and one characteristic trait of the 70s was mass confusion about what is actually going on. And you don't read this many places. Nobody talks about it. I read it in one book, and it was repeated over and over in that book. And this is a guy who's a historian who read all the articles, who lived it. Like he lived in it in the moment. And he also brought in a lot of news articles and everything. And you read it, and it's like constantly, every chapter, this period was marked by mass confusion. Nobody really knew what was going on in the economy. Everyone was confused. They were confused about stagflation. Stagflation wasn't coined till later. It wasn't coined initially. It's not like we had this in the 60s and we're like, oh, it's stagflation. No, we didn't have that as a marker. We created the name to describe what was going on. And so people were confused. And even in the moment, they were confused. And I think you can tell that by the asset prices. If you look at stocks, they went to a really low valuation, which was great if you're buying. Warren Buffett had a field day, right? He made a lot of money during that period. And if you had bought really good stocks in that period, you also would have made a lot of money. But what happened was a lot of people were afraid. And also you got 20% interest rates. So, hey, if I can buy a 20% interest rate bond and live off it for the next 40 years or 30 years, if you're a 30-year bond, why wouldn't you do that? I wouldn't buy equities. Why not just buy a 20% bond? I mean, what's wrong with that? So anyway, I think what the message I'm giving is that this is a difficult period of time we're entering in, where it's really confusing to most people. It's largely confusing because for the last 40 years, you've had a paradigm that you've got accustomed to. Everyone has. A whole generation of people in the Wall Street have never seen the 70s. Probably most of them haven't seen the 70s. They didn't live it in the markets. So they don't really know what happened. They just read books and somehow expect to learn this stuff. We haven't experienced it. And so when you have a generation of people who haven't experienced it, they don't have the history, they don't have the wisdom of how to navigate it. And so when you're trying to navigate this, you're using a different set of tools. Your set of tools is for the last 40 years, when you should be using a completely different set of tools, but you don't know what those tools are yet because you haven't lived it. That's a challenge for a lot of people. So that's a big part of what we're trying to do in the show, is educate people that you need to look at the tools, you need to read history, you need to understand what happened, you need to talk to people who understand this period, because if you don't, you're going to get confused. Like, for example, this year, one of the largest tech companies in the world, or largest companies in the world, is down, I think, like, what's it down right now? It was down some, I looked at it yesterday. It was down some crazy amount. I thought it was down like 9%, but come to find out it's down even more. And this is a company that like is just getting massive growth every single year. And everyone's just like, oh, you just invest in this and you can forget about it. Well, no, it's down like 10%, or maybe it's 12. Anyway, it's down in a year where the stock market was up 10%, and this is down. That shocked a lot of people. People aren't accustomed to that. Right? And it has nothing to do with the company. That's why I'm not going to mention it. But it has nothing to do with the company. It has to do with the fact that the Magnificent Seven, which everybody just was accustomed to just throwing money in and expecting it's going through the roof, it's not doing that this year. Some of them are, some of them aren't. You know, one company is down at least 20%. It's down a lot. I'm trying to pull up the amount. I'm not going to name them, but you can figure it out yourself. Yeah, one company is down. It's down 30%, 25%. You know, some of them are up. I'm not going to chastise them all. Some of them are up this year, and some of them are down. That is not normal. That's not what we've seen in the last 10 years. They're all up every time. Oh, that's why the Magnificent Seven, they always go up. We're up 100% in 1 year. It's crazy. So my point isn't you should or shouldn't invest in these companies. My point is that we've gotten accustomed to just throwing our money into Magnificent Seven, assuming they're going up some magnificent amount every year. And that's not always the case. And there are companies that you've probably never heard of that are doing quite well and are paying good dividend. And they're called value stocks. I know, Barb, you've heard of value stocks, right? You remember those?
Yes, I'm just waiting for that rebound.
Yeah.
But Kirk, you teed me up for what is one of the really, really important concepts in investing, which has kind of fallen by the wayside for the past at least 15 plus years, which is valuations do matter. So, valuation, and James got into this a little, which is kind of evaluating what the fair value is of a company based on concrete things like earnings, like price related to earnings, like book value, like return on equity, like debt levels. And from that type of data and analysis, you come up with a fair value for a company, what is reasonable to pay. And that's kind of called fundamental analysis. But if the price is way ahead of that fair value, then we would call those stocks overvalued. And flip back to the 1990s, and people were diving in to these tech stocks. Technology was, obviously all the rage as it is today. And the valuations, the PE ratio, which is price to earnings, how much an investor will pay for a dollar of earnings, average went up in the double and even triple digits, which is stratospheric. That is so, so high in a valuation in contrast with the underlying intrinsic value. So what does that mean? Well, it's this very akin, although stocks are not as overvalued today as they were in the 1990s. What it means is you're going to either have to get monumental growth in order to justify that high valuation. And I don't mean 10, 15, 20%. I mean 100% growth in order to justify some of those high valuations. Or at some point, and this is the kicker, we don't know when, because stocks can remain overvalued for years and years and years. But at some point, they will come back down. And that's what happened in 2000, 2001, 2002. We ended up the decade between 2000 and 2010 with an aggregate return on stocks being, I'm not going to give, don't hold me to this, but it was in like the low single digits. It was just relatively very, very low. But it makes sense because we started off from a level where stocks were supremely overvalued. So, what's the point? The point is that you need to be aware that any asset class will not remain overvalued forever. The trick is to understanding that it may remain overvalued for a really, really, really long time, and you don't know when that's going to shift. And so I'm not saying, get out of stocks when they're overvalued. I'm not saying that, you can pick when stocks are going to have a massive correction, which they will, and that happens all the time. What I'm saying is kind of piggybacking on what Kirk said was have some awareness of the historical behavior of the assets you're investing in. So understand, don't get into a stock market, either an individual stock or a fund, with the idea of, well, in the past, 10 years, we've seen 10, 12, even maybe higher aggregate growth in some stocks, annualized growth, and say, well, that's going to continue in the future. But understand it's likely not going to continue into the future. So you have to really spend a little time if you're going to be a stock picker, or even if you're going to be an investor, of understanding the characteristics of the markets that you're investing in.
Yeah, I think it's really important. If valuations, if you think about, and I'm trying to pull this up while we're talking, but if you look at historical valuations, there are times when things are historically cheap, like the late 70s, or pretty much in 74 and 79 and 80 and 81 and 82, things were historically cheap. Um, there aren't many times in history that happens. It happened in the 40s, late 40s, early 50s. You know, it happened in 74, and then it happened pretty much from 77 up until around 82, where things were historically cheap. They were under a PE of 10. And then you look at pretty much the late 90s, early 2000s, we had a historically expensive PE above 20. And then, of course, you had pretty much from 2015 until today, you had a historically expensive PE. Um, you know, you could argue what contributes to that, but what I've always found fascinating with inflation is this: is that if you have, um, I'm always looking at the data points and saying, why do things work the way they work? Because a lot of people come out and say, we're printing lots of money, there's gonna be massive inflation. I'm like, okay, where is it? Where's the inflation? Like all the gold bugs, like, oh, they're printing tons and tons of money, we're gonna have hyperinflation. Okay, where is it? Where has it been for the last 20 some odd years? Now, granted, we did start to have it in COVID, but that was for a very different reason. Prior to COVID, we were printing massive amounts of money. What happened to the inflation? If anything, inflation, in my argument, I think we had periods of deflation in there that weren't acknowledged, but like, what happened to that? And so, because, you know, the textbook definition is printing money equals inflation, but we didn't have it. So why not? And a lot of it comes down to a few factors. Technology is highly deflationary. The trend of technology is highly deflationary. You know what else is deflationary? Is the fact that we were outsourcing our labor to China. We were outsourcing our inflation to China through labor. So that caused our inflation to drop. Those are two major trends, right? Um, you know, we have stagnant demographics. They're growing a little bit, but you know, that can be a factor. Like in Japan, deflation is a demographic factor. Anyway, the point is when you see these things, you say, huh, that's interesting. Why didn't this happen? You hear the same people telling the same story. We're going to have inflation overnight. And then it happened. They're like, look, I was right. Like, you were right 20 years later. That means your thesis is wrong. Right. The reason it happened had to do with the fact that we reshored inflation from China because of COVID. We had a supply chain problem, which caused all sorts of issues in pricing. Um, and that was a temporary inflation, which was normal. That's expected, right? It had the bullwhip effect, which I'm surprised we haven't had it whip back yet. But the supply chain has largely been stabilized. So that's not causing the issue, but inflation's picking up a little bit. You know, what's interesting is I don't think we're ever going to go back to the low inflation environment that we had, because that requires us to outsource our labor to cheaper countries. And because of COVID and our spats with China, we can no longer use China for our primary source, which means our labor costs are going up, which means product costs are going up, which, you know, increases the cost of everything, which means inflation is going up. Does that mean it's going to continue to go up? I don't see that. I don't see a reason for it at the moment. I mean, it could be that some other problem happens that caused it, but given a somewhat stable economy or global economy, I don't see it spiking again. It could. I just don't see any reason for it. So if that's the case, um, you know, what's going to happen? We're printing massive amounts of money. Well, that could cause inflation, sure. But we still have these big factors that are a deflationary effect. We still have technology, which is a huge factor. What's going to happen with technology? Technology reduces our costs every year. So, I mean, these are really interesting things. You didn't have this problem in the 70s. You didn't have technology reducing the cost of everything across the board. And we have, you know, we have AI coming. We have all of this stuff. You know, we have blockchain. We have all this technology that's just completely changing the landscape and reducing costs. And we can't even predict it all that well. I haven't heard anybody come out and really predict it really strongly, like, here's what it's going to look like. Nobody really
Well, that's
knows.
that's the thing, Kirk,
Yeah.
is that we have so many massive changes going on, and it's almost like when the internet came out and we all thought, "Oh, this is fabulous. This is going to be great." But we didn't know how. We didn't know what the impact would be. We know what the impact of the internet is now. What we don't know is the impact on our economy of AI, of blockchain, of these major paradigm shifts in our ecosystem. But I do want to pick up on your globalization statement, because globalization, when we outsource production to countries with lower costs, that is stabilizing our prices now. And that is insane. And we went through that for, decades. I mean, I remember I would pay like X amount of dollars for a sweater 30 years ago. And up until recently, until inflation kicked back in, I was paying the same price 30 years later. Same for just minor inflation for a car up until recently. But we can, it's almost, I believe, impossible to have outsourcing at the same rate as we had initially. And so that deflationary impact on pricing is gone. But on the other hand, we have almost full economy, Kirk, and we haven't discussed that at all, because what that does is that increases increases wages, because when there is almost full economy, employers are going to need to keep paying up to retain their employees. Yeah, there have been some partial layoffs recently, at least in the Bay Area, but in general, low unemployment rates put a little bit of upward pressure on wages, which could in fact impact inflation. So all this together is combining what we said in the beginning is we're in kind of uncharted waters. We really don't know what's going to happen. We also have a degree of global unrest, which can have a huge impact on global economies.
Yeah, and
So,
that's a great point, Barb, with the global unrest. And oddly enough, it hasn't had as much of an impact as you would have thought, though, right?
not yet, but I feel like, and I'm a pessimist at heart. I'm always waiting for the other shoe to drop. And so no, it hasn't, but like you said, like I've said, we just don't know. Life is uncertain. We don't know what the future holds. Um, so that makes us feel like, that raises the question, what is an investor to do, Kirk?
Yeah, it's and this is part of the problem, right? We also had a lot of global conflict in the 70s, many different events. And what's interesting is back then, I think many of those led to stock market corrections and whatever. We're not seeing that. We're seeing the Middle East, I don't want to say it's blowing up at this point, but there's definitely a spark of things blowing up. And um, the economy, you have a day where the stock market goes down and then it's just like, whatever. All right, there wasn't a nuclear war today, so we'll go back up. I mean, I if I look at history as to what has happened with the economy and any sort of event and what's happened, we're in a very different place. The economy, let me rephrase that. The stock market doesn't give two craps about global events anymore. It doesn't. We had a Ukraine conflict. Things went down for a few days. Oh, well, we're not having a nuclear war. Okay, great. Everything's up. The stock market's up. With the Middle East problems, you might have a day or two. All right, everything's back up. Like, no one cares. I mean, and I bring this up, not that it doesn't matter, but that it does. Because when you have a stock market and you have a big conflict or some problem in some part of the world that could expand exponentially into other parts of the world and the economy, and the market just totally doesn't give two craps, that's actually a sign that the market is not healthy. because a healthy market looks at that and says, I'm taking my chips off the table. I'm going to see what happens. That's a healthy market, right? You look at COVID. COVID was a mix of the two because, yeah, the market went down 30%, but the whole global economy was shut down for weeks. And somehow that didn't send the stock market to zero. I don't know how, because I mean, everyone's sitting in their homes, nothing's working. Oh, well, don't worry about that. We'll be fine. Like,
What well, I think a lot of it was that there were so many government programs pumping money in that people were still spending
but that was
and they were
later.
saving. And so that counteracted the shock. And I think a lot of what happens today is we don't let the natural market forces take place. We try and stop them, which in some senses is good and has, I would say, kind of given us a little bit of an upward boost in overall stock momentum. But I don't think it can continue forever. Do you, Kirk?
No, I mean that's the point. Is that it's not a healthy market. It's not a free market. It's not a healthy market because you, like you said, the government pumped a lot of money into the economy. Yes, it did, but you couldn't buy anything. Like companies were shut down. People were sent home. How do you? My point isn't that it was the end of the world. My point is that when you look at it in the moment and say, all right, everyone is shuttered in their homes. They're not spending money. I mean, they are to some extent, but they're saving. When you're saving money, means you're not spending it, Barb. You know what I mean? Like, during that period, I had a lot of extra cash in my account because I wasn't spending on anything. And I was like, wow, I don't have to pay on gas. I don't have to buy stuff for my kids. We're just stuck in the house. Like, I'm just watching Netflix. Like, I can save a ton of money, right? And so when I look at that, I'm like, oh, this is pretty cool. But then I look at the global economy and I take my situation, everyone else is not spending money and companies are shut down, people aren't working. I mean, some are like basic essentials, but we were told like not to go to work like for weeks. And that was before the government gave everybody money. So you didn't even know what you were getting. And knowing the government, that could have been months before we got. I mean, I think the government actually got their stuff together quite well, and I don't frequently compliment the government on much of anything. I think they did a reasonable job of getting their stuff together and getting money out to the people really quickly. So I give them a lot of credit. And I think yes, there were excesses, and yes, there was fraud and all that, but you couldn't do that well any other way. I don't think there was a better way that they could have done it. So for all the people who said, yeah, they did a bad job, they didn't do a bad job. We had such a confluence of events and incompetent people. For the fact that we have incompetent people trying to do a competent job, I think they did a good job. So I give them two thumbs up for the fact that it's probably the only time I ever complimented the government. But they did a good job. But that took a while in order for that to come out. And the Fed took a while to support the economy. They just kind of let it go and they're like, all right, like, yeah, I guess we'll do something, but that was later. And eventually they supported the high yield bond market, which was later. Like they did some things, but it didn't happen right away. So why didn't the market drop like 50%? I mean, or more? Like, and that was the question I was asking myself. Where's the bottom? How do you know what the bottom is? You can't you can't like deep water test this. Oh, let me look at history. Well, it's never happened in recent history. So how do I know where the market is? I don't. And so my point is that went down a lot less than it should have. And also ended up the year positive, which was also an anomaly. Why was the economy up higher at the end of the year when we're in the middle of COVID? That was also crazy. That's an unhealthy market, right? And because of what Barb said, because of government money was a big part of that, obviously. Um, but you look at now and you say, all right, we have these very obvious risks at an overvalued market. And then you have a blow up in two parts of the world. We had one in Ukraine and we had one in the Middle East. And that is not causing problems. A little bit, but not for what it could be. Now, if I was an investor in that area, I would take all my chips off the table. When that when Hamas attacked in that day, like I would have taken all my chips off the table and be like, all right, I'm out of here. Like, because how do you know what's going to happen? You don't, right? And we know what's happened now, but that could have blown up much, much worse, and it could continue to get worse. Now that you have Iran in the picture, it could get really ugly, but no one seems to care.
That in my mind is a problem. It's not that it's not a problem. It could be totally fine. But when you have the market that is accustomed to discounting everything and saying everything will be fine, so we're just not going to change, that's not normal. That's not normal market behavior. That's not normal market participants making informed decisions. There's none of that. That is an unhealthy market, which means that it's what tends to happen is you tend to have these spikes. Because in a healthy market, people would say, all right, I'm gonna take some chips off the table, I'm gonna reduce my risk. But when people just don't care, what that means is someday a bunch of people are somebody's gonna yell a fire and they're all gonna run for the exit and they're not gonna get out. That's what's gonna happen, which leads to a crash. That's what happens with crashes. People just, like 2008, perfect example. We had a year to prepare for the fall of 2008. We had a full year where people knew about it. I knew about it in August 2007. I didn't know how bad it would be, but I knew it was a problem. I wasn't the only one. Other people found out through 2008. You had a lot of time. Very, very smart people had plenty of time to prepare. Did they? Nope. All of a sudden, one day, crash. Because everyone decided one day, oh, well, this is a problem now. That was an unhealthy market too. We knew that. And that's why the crash happened. So we're in another period. I can't put my finger on where the problem will come. But to me, when you have an unhealthy market like that, that tends to lead to problems down the road, things that are unpredictable that will cause bigger problems. So it's just something to keep an eye on, right? I'm not saying there's going to be a crash. I'm not saying, but this is where the 70s was a problem too, because people were confused. Why is this not affecting in the normal way it should? So my confusion is normal given the framework that I'm giving you for the 70s. And that's my point, right? Is that we're in a different paradigm, different inputs lead to different outputs. And if you don't know that, if you're not aware of that, you're going to get yourself into trouble. If you're aware of it, you can at least, you have your antennas up and you say, all right, this is something I need to be paying attention to. So I know we're probably going to wrap it up here, Barb. Final thoughts from you.
Okay, so sum it up today. Things are uncertain. We don't know where the market is going to go from here, and what should we do? First off, things are always uncertain. We never know what the market is going to do. So what is an investor to do? Do you make a prediction? You pull out of all stocks? You think, oh, sometime there's going to be a crash. I want to be prepared. No, you go back to tried and true principles. Understanding that markets are volatile. Stock markets, bond markets, investment markets, they go up and they go down. So before getting in, you have to understand that. Despite the fact that trends are typically upward over long periods of time. So we go back to basics and just, tune out if you've heard me say this before, which you have, which is be diversified within your investments across sectors, across types of investments. Don't be overly aggressive if you're going to need money from that investment account within the next 5 to 7 years. Have some cash available for your short-term needs. I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and at YouTube. And I will see you next time on Money Tree Investing Podcast.
Great. Thanks for coming on, Barb. That's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.